When most people think about tax, they think about a lot of rules and a lot of complexity. Stacks and stacks and volumes of Internal Revenue Service publications, Internal Revenue codes, just lots and lots of stuff going on. And you might recall when you first started learning about tax, wow, there's all these different rules. There's a general rule, there's the exception to the general rule, there's the exception to the exception, exception to the exception. There's just so much, right? It just goes on forever. And you're like, how do practitioners, how do they remember all this stuff? Well, I'm here to help you. And one way that we practitioners, that we master tax is by understanding some different themes in the tax law that will help you hugely understand how the tax law works and how the pieces of the puzzle fit together. So one of the reasons why I love the tax law and the reason why I'm wearing this suit is because I love how when you understand these different themes and how the pieces of the puzzles fit together, it starts clicking and it feels good. So this is my Tetris suit. And if you ever played Tetris, you ever put together a jigsaw puzzle, it feels good, right? When you're getting all those pieces to fit together and then the picture is starting to work out. Think about topics like characterization or property transactions, and there's lots of other ones. Think about how many different things you gotta worry about here or there, right? It's all about putting these pieces together. So in this video, I'm gonna provide you some tax themes that you can use so you can master tax practice. All right, let's go ahead and jump into it.
I have 16 tax themes that will help master tax law. Now, these themes come from 2 other videos. I want to make sure you watch those videos. These are the top 100 tax code sections and the tax scavenger hunt videos. Make sure you watch those, and as you go through those videos, you will see these tax themes emerge. You might see some other ones I talked about, but these are the big ones, and there are many other ones out there. Okay, let's go ahead and start. So this is meant to be a summary. Again, go back to these 2 videos and watch those videos because you will see how they fit into the items that I mentioned, how everything kind of fits together. So the first one, look at the structure of the Internal Revenue Code, specifically the table of contents and groupings of various topics. Now, in the top 100 tax code sections, as well as the tax scavenger hunt, we started by looking at the table of contents, the structure. We went through. We started at the subtitle level, and then we went all the way down to section. And we talked about how we have we're looking at income taxation, which is what we're dealing with in these videos to help us understand. We look at the subchapters and how these different subchapters, what you see is you start seeing, okay, there's a pattern of emerging areas, emerging topics. Specifically, we saw Subchapter C dealt with corporate tax. Subchapter K dealt with partnership tax. Subchapter S. So you start seeing that if you're doing tax research for the first time and you know, hey, I have an issue that deals with this respective area of the tax law, I can go into that subchapter and I can get further. That will eliminate a lot of those code sections and help you tremendously. So it helps, you know, as many of you know, there's so many tax code sections. There's so much tax law out there, and Internal Revenue Code is such an important aspect of where to start your tax research. So let's try eliminating what's not important. Okay, there's a lot that is important, but let's eliminate what's not important so we can get to a manageable level. Okay, let's go to the second theme. So every code section has a tax treatment rule and at least one proposition. So we saw this when we just started out, and some of those tax treatment rules, they when you're dealing with income. Okay, we saw looking at subchapter B, like section 61, right? Part 1, part 2, part 3. We saw include an income and exclude from income. Okay, some people say exclude an income. I like to say exclude from income. But the idea is the verbiage is include and exclude when it comes to income. So if you're giving the tax treatment rule for a code section deal with income, it's include or exclude. That's the tax treatment rule. When you're dealing with deductions, also in subchapter B, when we got down to part 6, part 7, part 8, part 9, allow and disallow when you're dealing with deductions. That's the key language. When you're dealing with property transactions and recognition, right? Recognized gain, you've got the recognized gain and the non-recognition or not recognized gain. So gain or loss. We say recognized gain or loss or not recognized gain or loss. That's a very popular one, okay? And there's other tax treatment rules. There's define. There's so many other ones. But every code section has a tax treatment rule and at least one proposition. Propositions are important because those are the requirements you need to meet the tax treatment rule. So we saw some examples of that in the tax scavenger hunt video, where we went through and looked at, okay, where the general rule is, where the exception is, where the exception to the exception. And basically the idea is that to have the general rule, you've got to meet requirements. Okay, we talked about section 162 and how Section 162 has different elements. Has to be, in order to have a trade or business expense that's deductible, you have to have an ordinary, necessary expense that's during the tax year, paid or incurred. Sorry, let me phrase it. I phrased it out of order. Have to have a ordinary, necessary expense during the tax year and carry on a trade or business. And those are the requirements. So each of those things, as you see, I break out, right? Ordinary, necessary, expense, during the tax year, in carrying on, a trade or business. Each of those phrases, each of that terminology, those items, those are requirements. And those requirements have been defined by an area of jurisprudence, Supreme Court cases and other court cases with those issues. What is ordinary? That's an issue. That is a requirement. It has to be ordinary, has to be necessary. So Section 162 is a perfect example. If you go and you look at the language of Section 162A, you will see that. You will see that there are these requirements to get the tax treatment rule, which is to allow deduction. Okay? Let's go on to number 3. Speaking of income and deductions, income has been construed by the courts to be broad, and deductions have been construed to be narrow. Now, the idea here is we're talking about the Internal Revenue Code, and you're like, okay, well, why are we talking about case law? Well, as you know, and as I've said many times in many of my videos, yes, the Internal Revenue Code is where you start when you do tax research. However, it is in no way the ending point. You do not just end there. You just don't say, okay, I found something in the Internal Revenue Code, I'm done. The Internal Revenue Code has very broad language. It's meant to be in broad strokes by Congress. The idea, take Section 61 for example. Section 61, go read Section 61, defining gross income. And I did this, and I talked about Section 61 in the other 2 videos as well. But Section 61, it defines gross income. It says income is all income from whatever source derived. Don't you hate when someone defines something with its own title? Income is income, right? The idea is that Congress, it kept the definition of income as broad as it could, because back in 1913, when it wrote in the language for gross income and defining that, it used the extent of allowable under the Constitution. Look at the 16th Amendment. It actually has that from whatever source derived language. It wanted to keep that broad extent. So the idea is that in 1913, Congress didn't know that there would be internet transactions or computer transactions. That wasn't even fathomable in their minds, something like the internet. Okay? So they couldn't put every little thing. Now there is a list of items in Section 61 that deals with, hey, these are gross income, but it's not meant to be an exhaustive list. And that's another thing I have on the tax themes. We'll talk about that later. But the idea here is that over the years, through the Supreme Court jurisprudence, through other court cases, the Supreme Court and other court cases have construed income to say, hey, when there's issues of interpretation, which, hey, the courts, they interpret the law by Congress as established in Marbury versus Madison, we're going to go in a broad. We're gonna go on a broad angle. Okay, we're gonna construe income broadly. So it's gonna be construed broadly to be, okay, income will be more broad and it will include it in cases where we're not sure, or not sure, but it's open. There's issues of interpretation. Deductions, on the other hand, are going to be construed narrowly. Okay. New colonial ice, there's many cases, many Supreme Court cases and other cases where they say this, that income is to be construed broadly, deductions narrowly, but one case is New Colonial Ice. I have a video on the top 50 cases, tax cases. I talk about this doctrine, and the idea is that deductions are matters of legislative grace, and they should be interpreted narrowly. So that means that if there's issues where, again, there's a line where it could be questionable one way or the other, the courts have said we're going to go in favor of the IRS, and we're going to say, hey, that deduction is going to be disallowed, to be defined narrowly, okay, or construed narrowly. Okay, let's go to number 4. So the tax law starts analysis of inflows. So if we deal with inflows, which really deals with income, right? Whether income is included or excluded by determining if a specific inflow is gross income under Section 61. If an inflow is not gross income under Section 61, it's not on the tax return. If it is an inflow in gross income, then you must consider whether there are any specific exclusions from gross income applicable. If there are no applicable exclusions, it's reported on the tax return. But if there is an applicable exclusion, then it will be excluded from the tax return permanently. So what this is dealing with, and this is something that I really stressed in the top 100 tax code section videos. If you look at the table of contents and you go to subchapter B, specifically look at part 1, part 2, and part 3. Part 1 defines gross income in section 61, and it talks about calculating taxable income and adjusted gross income, those things. So what it's saying is, hey, when you're determining if an inflow is going to be reported on the tax return as income, you always start with section 61, defining gross income. In that video and in my top 50 cases, there's a case called Glenshaw Glass where there's 3 propositions that have to be proven. And again, go back to that video, the top 100 tax code sections, I talk about that. You need to meet all 3: accession to wealth, realization, dominion, control. If you have all 3 of those things, again, that's not in the code, it's in the case, Glenshaw Glass, then you have section 61, gross income. What it's saying here is, hey, if you have gross income under section 61, Glenshaw Glass, then you continue. But if you do not, then look, it says that it's not included on the tax return. It's saying you stop, it's not on the tax return if it's not under section 61. So one thing I like to, when I teach tax, I love to use 2 tools, 2 methods to teach. I love to use tax themes like you're learning now. Also, I love to use checklists. And a lot of my other videos, tax videos, I use these checklists. I actually have a video on section 61 gross income, and I go through the checklist, and it uses this checklist. And what it says is, again, you start off asking if a specific inflow is income to be on the tax return. And if it's not under that Glenshaw Glass, it's not going to be on there. But if it is, then you continue on to part 3. Now, part 2 deals with specific inclusions, things where there's special rules like annuities, group term life insurance, vesting under section 83, special rules like that to help us with section 61. Congress basically lays out special rules. So if we do have gross income under part 1 and part 2, then we continue on to part 3. Part 3, and if you want to stop the video, that's fine. Go look at part 3 of subchapter B. You will see that it deals with exclusions from gross income. So the language, again, is include and exclude. So if you do not have section 61 gross income, that means that it's excluded from gross income. But then there's these exclusions that Congress specifically lays out if you do have section 61 gross income that says, hey, if you have section 61 gross income, it might still be excluded. Perfect example is interest. If you think about bond interest, okay, from a city, like the city of Atlanta, and let's say that city of Atlanta qualifies as a municipal bond under section 103. Well, under section 61, interest income will always meet the Glenshaw Glass, okay? Because you have accession to wealth, right? Your net worth gone up. You have realization because it's separate from the bond itself. You have, this return on investment, and then you have dominion control. You can do whatever you want with it. You want to spend the money, you want to save it, whatever you want to do. Those are the 3 parts you need under Glenshaw Glass. So boom, we have section 61 gross income. So it says if the inflow is gross income, then you must consider. So then we go to part 3, we look at exclusions. That starts with section 101, okay? And it goes through the 130s, the late 130s in that area, 140, okay? And if you look at those exclusions, you will find section 103 says that municipal bond interest is excluded from gross income. So it's like, hey, that would be included in gross income, but for this exclusion. But we do have the exclusion, and therefore it's excluded under section 103, and it's not included on the tax return. So that's how you look at this. And that's very, very important to understand tax. You need to understand that because when you first learn tax, that's not as much stressed as, when you're first learning the rules, like the substantive rules, right? You're learning these rules like, hey, municipal bond interest is excluded from gross income. But when you do tax research, it's very, very important to understand that because if you're dealing with something that you're not sure about, right, something new, you've never seen, you have to understand the structure, right? You start off with section 61, and then from there, you continue and you say, okay, well, are there any exclusions? You look through the exclusions. If you don't have any exclusions, then you're done. you conclude, hey, it's gross income. But if you do have exclusions, you need to note that. And that can make a big difference in tax research, because if you skip those steps, you might be getting the wrong result, and that's obviously malpractice. Okay, let's continue on. So number 5, and versus or language found in the code, specifically in propositions and requirements. So we saw some examples of this, and I talked about this with section 162. So in section 162, and I mentioned it earlier, you've got all these requirements, right? Ordinary, necessary, expense, during the taxable year, in carrying on, a trade or business, right? All these different things. And the idea is that it's and. You have to meet all of these things, all these requirements to get deductibility under section 162. But some code sections, it's or. You can have this, or this, or this, okay? And the idea there is you only have to meet one of those things. So it's kind of like diagramming a sentence back in an English class you might have taken, right? It's very nitpicky. And that's the same thing in tax law construction. If you have and language and or, you got to make sure to follow that. So always, always, always look for and versus or language. Because if you're looking at a code section that says, oh, it has to be ordinary, necessary, expense, paid or incurred during the taxable year, in carrying on, and it must be a trade or business, you know, hey, it says and. I have to meet all of these criteria. But if it says or, you know, you have to meet one of those different requirements. That's the idea there. That one's pretty straightforward, but it's also a very important one. Okay, number 6. So we saw this in the code in the tax scavenger hunt when we went through. Whenever you read a code section, many times in the code section it will say for purposes of the subtitle, for purposes of the subsection, for purposes of this part. That language, if it says section or purposes of the section, subtitle, that's very important. Because if something is defined in one code section or is used in one code section and it says for purposes of this section, that usually means that, hey, you can't use that definition for another section. But if something it says for purposes of this subchapter or for this subtitle, then it means you can use it for the entire thing. So one example of an area that goes throughout the entire Internal Revenue Code are the definitions of section 7701. Okay, and I talked about this in the top 100 tax code sections. If you look at 7701, it's actually certain definitions that apply throughout the entire Internal Revenue Code, throughout the entire title. For purposes of this title, these things mean this. Okay, so you can have very broad language or very broad items. You can also have very narrow items. For purposes of this section, you can find that language as well. And if you want, stop the video. Go pull up the Internal Revenue Code and pull up some code sections. You will find this. You will find that, this language for purposes of this. Okay, so go ahead, stop and go look. If you're really trying to master this and learn this, whether you're taking my class or you're just trying to become an excellent tax practitioner, stop the video. Go look at the code. While I'm talking about these themes, you can look these up. You can look at these things. Okay, let's go to the next one. So number 7, there are many lists in the code that are merely illustrative and do not provide all possible circumstances. One common list, the examples of items considered gross income in section 61. Note that these are not only inflows that are considered gross income, just some of the more common forms of inflows that are gross income. So we talked about this earlier, and it's also mentioned in the other videos. Section 61, if you go and read that, you will see again that Congress uses very broad language. It says income is all income, or gross income is all income from whatever source derived, including these items. But these aren't exhaustive. That does not mean that these are all possible items. And you have things like wages, interest, rents, royalties. Again, stop the video, go look. Go look at these things in section 61. This list is not meant to be all-inclusive. It does not provide all possible. And the reason why is because Congress wanted to keep the language extremely broad because, again, in 1913, they didn't think about things like technology like we have today, like computers and internet and, all these different crazy things. They didn't even fathom those things in their mind. So they didn't understand, mining cryptocurrency, that would be gross income, which it is, okay? So that's an example. The idea is that there's many times throughout the tax law, like section 61 or section 1221, where you're going to have a list of items, and not all these items are going to be, that's not going to be the only list. But there will be other times where those are the only things. Those are the only requirements. Those are the only things out there. Okay, so it's really important to keep that in mind. Keep that in mind that sometimes it's, it says including, it might just be, okay, some examples. Congress wanted to give us some examples of the common areas of income like interest, wages, rents, royalties, things that we normally think of, okay? Okay, number 8. Note that while Section 61 in gross income has been interpreted broadly, there are some sections that Congress wanted to bring specific attention to make clear. So this deals with Part 1 and Part 2, and I brought this up in the top 100 tax code sections. But if you look at Part 1 and Part 2 of subsection B of the income taxation subtitle in Chapter 1, what you notice is Part 1 defines gross income and also talks about taxable income and adjusted gross income, these things. Part 2 says specific inclusions. Now, you might, when going through that, you might be like, okay, well, it seems a little redundant in a way because isn't Section 61 the general definition of gross income? And you're right, it is. But Congress wanted to provide some specific code sections dealing with specific topics to provide help. And that's found in Part 2. Or they wanted to specifically bring attention to areas. And one major example, I always bring this one up, is Section 74 dealing with prizes and awards. So if you go on a game show, and a video game show, TV game show, and you win $1 million, that is going to, and there's no restrictions, you can do whatever you want with the money. That's going to be obviously Glenshaw Glass, the 3 requirements. You've got your net worth goes up, so accession to wealth, realization, right? You got, well, services are always considered, you have separation or it's severable for services. So because the money is the $1 million you want is a result of your hard work and I don't know, being a trivia whiz or whatever. So that's going to have severance always for services. And then dominion control, can you do whatever you want with $1 million? Yes, you can. So that would be gross income under Section 61. So why do we have a code section that deals specifically with prizes and awards? That starts off saying that prizes and awards are gross income. Well, Congress wanted to point out and make specific attention because some people were playing games with this interpretation of oh, well, they obviously did not mean this, right? Oh, someone going on a game show. Also, Congress does that because maybe they want to start with a general rule and then they have exceptions, just to make it kind of flow logically with a general rule, exception to the exceptions, as we talked about in our videos. So under the broad view of income under Section 61, prizes and awards would clarify, clearly fall, I should say, within Code Section 61. The example I just gave, $1 million you win on a trivia show on TV. However, Congress wanted to make clear that prizes and awards are gross income due to issues on TV game shows, etc., where taxpayers were trying to make other arguments. So again, there were some crazy arguments being made, and they wanted to make clear, like, hey, this is gross income, okay? Also, they did that because there's exceptions under Section 74. You'll find to certain prizes and awards if you do certain things. Okay, number 9. When looking at the exclusion of gross income, we noticed that Section 111 deals with a tax theme or tax doctrine known as the no double tax benefit. The general idea is that if something gets excluded from gross income, you cannot take a deduction with respect to the same activity. This means you don't get 2 tax benefits, an exclusion and a deduction. Note that there are some rare exceptions to this general rule in tax and theme and tax, and you find those in specific code sections. Now, I talked about this in the top 100 tax code sections. I talked about specifically, if you're going back over that video and you're like, where do we talk about that? I brought it up when we talked about Section 111 and Section 265. Section 111 you'll find in Part 3 of the exclusions under subchapter B, dealing with the taxable income computation. In Section 265, you'll find Part 9 dealing with deductions under subchapter B, where there's the disallowances. So the idea here is, as we talked about in our videos, generally taxpayers are almost always taxpayers. They want to defer income and they want to accelerate deductions, okay, time value money. And the idea is that tax benefits include excluding income and allowing deduction, right? You want to be able to, you don't want to have to record income. You don't ever have to include it in your tax return, right? Because you have income, it's a positive number, and you have to pay tax on that as tax rate, right? It's a positive and you're paying it at a rate, so you're paying tax on that. Deductions reduce that income, so deductions are good. So exclusion is good and deductions. That's why I mentioned these here. Now, there's certain things in tax where you might make arguments that, hey, I can get an exclusion and a deduction, right? For example, municipal bond interest. We talked about that earlier, right? If you receive interest from municipal bonds, City of Atlanta bonds, well, the interest you receive is not included in gross income under Section 103. We mentioned that one earlier, okay? And again, mentioned in my other videos. Okay, under the tax law, it's excluded from gross income. Now, if you borrowed money, let's say you get 6% interest on those City of Atlanta bonds, but you borrowed the same amount of money, right? Remember, or I use an example from another video. Let's say you borrowed $100,000 from a bank, and you're paying 3% interest because you have good terms with the bank and you have good credit. Okay, on that, so you borrow $100,000 from the bank, so you're paying $3,000 a year in interest. Okay, just keeping it simple. Let's actually say you actually pay that, so it, the amount's not increasing. It's not accruing. So that $3,000 in interest, generally speaking, subject to limitations, as an investor, you'd be able to take deduction on that interest, that $3,000 of interest you're paying. Okay, 3% of $100,000 that you're borrowing. Let's say you take that $100,000 and you invest it in the City of Atlanta bonds that pay 6% interest. So you're basically doing a $3,000 a year tax arbitrage. You're making $3,000 of benefit, right? You're paying $3,000 of interest, but you're receiving $6,000 of income. Okay, so that $3,000 is basically what you're pocketing. So the idea is that $6,000 of interest you receive from the municipal bonds, the City of Atlanta bonds, that's excluded under Section 103. So Section 265 comes in and says, no, you're not able to deduct the $3,000 of interest because it's related to a tax-exempt interest or tax-exempt item, okay? So that's considered the no double tax benefit. You don't get to exclude and deduct. And we go with the code section that comes earlier in time. Now, Section 111 deals with the reverse. It deals with, hey, if you get a deduction in earlier, like year one, and then year two, you are trying to, a perfect example I used was deduction for state and local taxes. So if you're trying to deduct state and local taxes, you're in a state where you pay income tax or property tax or whatever. So year one, you pay state and local taxes. Year two, you get a refund. Okay, you get a refund of those state and local taxes. Well, normally you wouldn't have to include that state and local tax refund, but because you got the benefit of the deduction in year one, you're getting a refund due to you overpaid your expenses and you got a deduction for that under Section 111. You're gonna have to include that. So normally you wouldn't have to include the state and local tax refund because it's just someone paying you back what you're owed, right? Like a loan. Right? But you got a benefit, right? If you took $1,000 state and local tax deduction in year one on your tax return, and then let's say you overpaid by $200, so you only need to pay $800, right? That was your tax due. But in year two, you get $200 refund from the state. You have to include that refund. You're like, well, why? Isn't that a repayment of just money that's already yours, a loan? And you're right, it is. Loans are not going to be included under Glenshaw Glass because there's no accession to wealth increase because your net worth has not gone up, right? It's a $200 loan. You pay $200, right? But then, you paid it and you're getting it back. So it's like they're loaning you, you're loaning them the money, you're getting it back, right? It's a repayment of your principal. So normally, it would not be included, but because you got to deduct the full $1,000, but you really should only deducted on $800. This $200 is included, and that nets out, right? You got $1,000 in year one, you have to include $200 in year two, and notice that it nets to an $800 benefit. So that's the idea there. So Section 111 deals with where you have to include things now. So it's on the income side. Now you include in the later year. Section 265 now deals with you don't get to deduct in the future. That's the no double tax benefit principle. Basically, it says you don't get to exclude and deduct certain things. Now, there are certain exceptions. One exception of that deals with, that I can think of, a big one, deals with health insurance. The employer gets a deduction for health insurance that it pays for its employees, and then the employee does not have to include health insurance that's paid by the employer in their gross income. So that's an example. And these are special things carved out by Congress. Okay, let's go on to number 10. So number 10, the tax law starts analysis of outflows. So looking at deductions now. We saw in the theme for number 4, right, if you're looking at an inflow, that we went through the part 1, part 2, part 3. Now we're looking at outflows. So we're looking at deductions, okay? The tax law starts analysis of outflows by determining if a specific outflow is a deduction. So we're dealing with subchapter B, and we're looking at part 6, part 7, part 8, and then we have part 9. So part 6, part 7, and part 8, we, as you saw in previous videos, and if you want to stop, you can go back, allowance provisions for deduction. Part 9, though, it was disallowance. So just like we had a checklist when we talked about number 4, right, for income, we have a checklist for deductions. And the idea is that you start off asking, okay, is there a provision that provides for allowance of deduction? So we go to part 6, part 7, part 8, and there's other ones throughout the tax code, but those are where we find the general ones in part 6, part 7 for individuals, part 8 for corporations. And we ask, okay, do we have a specific allowance? So if it is a deduction, if it's not a deduction, then it's not going to be deductible on the tax return. So if there's not a specific allowance provision under those parts or elsewhere in the code, it's not going to be a deduction on the tax return. Okay? Going back to our, okay, we construe deductions narrowly. That's how Congress the courts want us to interpret. However, if there is an allowance, so if there is a provision that allows for deduction, you must then go on. You must go on to ask, are there any disallowance provisions? So then we go through the disallowance provisions, and there's many throughout the code, but one main area is part 9 of subchapter B, dealing with income tax area. And if there is a disallowance provision, like we saw an example with section 265, section 274, like limitations on meals and entertainment, the 280 caps, like 280 cap A, cap B, cap E, those are some big ones, 280 cap F. So if you do have a disallowance provision, then you're not going to be able to deduct it. Okay, so if there are no applicable disallowance provisions, then it is deductible. But if there is one that there is an applicable disallowance, then it will not be deductible. So again, it's similar to what we did with number 4. You got to go through and ask a question, right? You ask, is there an allowance provision that allows for deduction in the tax law? If there's not, it's not going to be deductible in the tax return. But if there is, you continue. And that's when you go to the disallowance provisions. And again, I have a checklist on this topic. If you go and you look at my deduction videos, you will see this, okay? So the disallowance provisions, do you have one? Is it disallowed? If it's disallowed, it's not going to be deductible on the tax return, but if there's no disallowance provision, then you can take it on the tax return. And that is the way that you would guide through a deduction provision. Let's continue on. Okay, number 11. Number 11 deals with the big 3 types of tax activity. So I call this the big 3: business, investment, and personal use. And it's in that order. Now, in the previous videos, you might have seen me put personal, and I usually say personal use because I'm trying to contrast personal property, okay? Personal for personal property, okay? So I like to say personal use, but if I said personal in the previous video, I meant personal use. You get the same idea, right? Personal, family, living expenses. But the idea is that in the tax law, there are these 3 activities and various code sections. They will provide different rules for different types of activities. The idea is the general rule. Let's start personal use. When you're thinking about just deductions, for example, for personal use, the general rule is that you cannot take any deductions. There's no deductions allowed for personal use, except unless you find a specific code section that says otherwise. So unless there's exceptions, such as mortgage interest, medical expenses, things like that say, hey, for personal activities in this area, you actually can take a deduction. For business and investment, the general rule is the opposite. Okay, let me change the color here. For business and investment, the general rule is that you can deduct, but there's going to be limitations, or obviously you have to meet the requirements. Okay. Now, if you have the choice of these 3, again, we go in order from top to bottom of what we want. If we have our choice, we want business. The reason why is because, well, the general rule is deduct, but it's the least limited. Investment is much more limited in terms of how you can take deductions. For example, think of investment interest expense. You might recall from other tax classes you've taken or my other videos, that interest expense, if it's investment interest expense, you're limited to the amount of investment interest income that you receive during the year. You can't just take it all. But business, if it's interest income, you could go the whole amount. There might be some limitations, but it's much less limited. So that's the idea. So if it's business, it's much less limited. Investment is the next best option because, again, the general rule is you can deduct, and then personal use is the last resort because no deductions are generally allowed unless you find something in the code that provides otherwise. So that's basically, it's very important to understand that. And there's lots of code sections, especially when you look at deductions, they break out this activity. Perfect example, if you want to see, go to section 165, the general rule for losses. The general rule for losses, it actually breaks out, and you'll see it says business or trade or business. It says production, collection or production of income, which is investment, and then it says, personal. Okay, personal, and it breaks that down. And you see that personal losses under the general rule of section 165 are not allowed unless they're personal casualty. So it speaks to our rules, and it says business investment are allowed, but it provides special limitations and special rules you have to follow. Okay, let's go to number 12. So the legal nature of property. We just talked about personal use, right? And I mentioned, hey, contrast personal property. The legal nature of property, personal versus real property, makes a huge difference in the tax law. There are many code sections that focus on types of property. Now, some of these code sections that we talked about in the previous videos, the top 100 code sections, they're all on the list, the top 100 code sections. But if I didn't, you can go in more detail. But if you want to go look at these sections, section 167, 179, 197, 1221, 1231, 1245, and 1250, because you'll see it makes a difference between real property and personal. For example, 1231, there are different requirements for personal property and real property. It makes a big difference there, okay? I have a video, by the way, on 1231 explained in 10 minutes, really helpful, and it shows you how that works out, okay? Now, personal property versus real property, as many of you already know, we define real property first. We say the land and everything attached to the land. Personal property is all other property. So this is a big thing. And it's actually interesting because in the Internal Revenue Code, Congress never actually defines the word property. It's actually defined through case law. Okay, it's very broadly defined. But these are important things because you're going to have differences in rules. Okay. By the way, I want to make a caveat. I should have made this caveat earlier, and I'll end the presentation on this as well. You see these code sections here, just like I mentioned in the other two videos, the top 100 tax code section video and the tax scavenger hunt. You might be watching this in the future. You might see a code section that's no longer applicable or there. Well, at the time of the video, it was. This video is not meant to be you're learning substantive material. It's meant to teach you the tools basically do tax research. You're learning how to learn. So as tax develops, these skills will help you. These themes will help you understand. So if you do see something, you say, hey, that code section doesn't exist or it was repealed, well, you get the idea. You get the understanding. All right, let's continue on. We're going to talk about recognition and non-recognition next, and that specific language. So non-recognition of a gain or loss is not the same as exclusion of income or disallowance of a deduction. Okay, so what we're saying is, if you ever remember, we talked about that lingo, that tax lingo, right? Include versus exclude for income, allow versus disallow for deductions, and then we had recognize and not recognize for gains or losses. So recognize, and this is something I always have to teach my students, and sometimes when they're taught in their previous classes, they're not taught this, and it makes it very confusing. Recognize or recognition. So recognize gain or loss. If you're not recognizing something, recognize, or I should say, if it's not recognized, my apologies. If a gain or loss is not recognized, that is not the same as a gain or loss being excluded. Okay, that does not mean it's excluded. Not recognized deals with timing, and I talked about this. I stressed this in the other videos. Okay, timing. What we're saying is that if a gain or loss is there's non-recognition, a specific rule says non-recognition, it's a timing. Congress is basically saying that it's not ready yet. It should not be recorded as a gain or loss. And every non-recognition rule has two themes in common, and I talk about this. And the first theme deals with the economics. Economics are the same before and after. And the second is the liquidity position. There's no cash to pay taxes. So perfect example deals with Section 1031 like-kind exchanges. If you're trading an office building for an office building and there's no cash that trades, well, that exchange to you, you're trading property for property, and that's going to be an economic event that could result in a realized gain or loss. Okay, but let's just say it's a realized gain. Okay, let's say that you trade an office building. Let's say it's a $100 million office building for another $100 million office building, and you're doing this because, I don't know, you're moving your headquarters. Okay, well, there's an inherent gain on your office building because you've been taking depreciation over time. Let's say there's a $10 million gain. Okay, $100 million fair market values you're transferring, $10 million gain. Okay, and because of this event, you might have to pay $10 million or gain on $10 million. Taxes on $10 million of gain. And let's just say, keep it conservative, 20% effective rate. So you're talking about paying $2 million in taxes. Well, when you traded the buildings, let's say that it was just a straight transfer. I know it's probably very rare to see this, of an office building for office building. No cash changed hands. So you don't have $2 million of cash sitting around to pay the taxes. So you're going to say, I can't do this transaction because I can't pay on the gain. So Congress comes in and says, no, we're not going to require that you record this gain this year. Okay, what we're going to do is we're going to not recognize the transaction under 1031, but that doesn't mean it's excluded. You're still going to have to worry about that $10 million of gain. How? Because every non-recognition rule has a corresponding adjusted basis rule. So in Section 1031, you will find an adjusted basis rule that says that we calculate basis a certain way. And what it does is that $10 million of gain, it goes into the new office building as a lurking transaction. We would reduce the basis by that $10 million, and we also reduce other things as well for boot and other things received. But that's the idea. So that if we sold the new building the next day, you would have $10 million gain if you sold it for cash. And that's the idea. Okay, so it's very important to understand that if there's a non-recognition rule, that's not the same thing as exclusion. That is not the same thing. Okay, contrary to whatever you were taught in the past. Okay, number 14, actually, look, I jumped the gun there. I love this stuff. I get very excited about non-recognition. I love property transaction stuff. As I mentioned, every non-recognition rule has two themes. And that's because, again, these are times that Congress says it's not right yet to tax you on these things. And Congress doesn't want to stifle the economy. They want you to engage in that transaction, that swap of the office building for the office building. Why? Because if you really do need to move your corporate headquarters from one place to another, that's why you're switching these office buildings. There's probably some economic reason that's going to help, in doing so, it's going to help grow your business or whatever it is. So the two situations or two themes that every non-recognition rule has, you'll find this. For example, if you take Section 1031, involuntary conversions under 1033, Section 351, non-recognition with a transfer between a shareholder and a corporation, transferring property to the corporation in exchange for stock. Section 721, when a partner transfers property in exchange for partnership interests. You will see these themes, they both are there. The first one is that the taxpayer's economic position is essentially the same before and after. So our office building, we have an office building before, office building after. Yeah, they might be in different cities, right? But they're still office buildings, worth roughly the same. And the second one is the economic circumstances do not allow the taxpayer to have the liquidity to pay taxes as a result of the event when the income is generated. So again, we have this $100 million transfer of apartment buildings, but there was no cash. So we have a $10 million gain, but there's no cash to pay the $2 million in taxes. So that could create a big issue. So when there's a liquidity issue, Congress comes in and says, you know what, we don't think it's right. This is why when you look at non-recognition rules, if there is any partial cash, it creates partial gain. So if you go look at the rules and like-kind exchanges, if you do get some boot, which boot is viewed as this liquidity issue, cash or other non-like-kind property, then Congress says, well, now you're taxable up to the amount of boot. So partial non-recognition. Okay, number 15 and 16. That's all we have left, almost done. So 15 deals with more property transactions. Love property transactions, right? We love them. And this one deals with an important rule in the tax law, and it deals with characterization. As we know, there's different characterization in the tax law, and the ultimate characterization, end of the day, long-term capital, short-term capital, right? Those are our options when it comes to capital and ordinary. Those are our three options. We have long-term capital, short-term capital, right? And that's either gain or loss, and then ordinary income or loss. Those are our three options, end of the day. Yes, there's some subclassifications like Section 1231 or Section 1245 subclassifications. So taxpayers, they prefer, of these choices, long-term capital gains. If it's a gain, they want long-term capital gains. They want it to be long-term capital. If it's a loss, they want it to be ordinary. Now, the gain is a little bit easier to understand, okay? Because as many of you know, long-term capital gains, they have preferential rates, okay? For certain types of taxpayers, okay? Losses, taxpayer prefers ordinary for two reasons. First, because if it's ordinary loss, it will offset ordinary income, which ordinary income is taxed at higher rates generally. Again, from individual taxpayers. We're assuming individual taxpayers, but depending on the taxpayer. And then the second reason why losses are better than any other choices is because there's so much limitation on capital losses, and you can see examples of this when you go and look at subchapter P, like sections 1211, 1212, and all the different capital gain, capital loss rules. There's less limitation on ordinary losses than there are capital losses. So that means the chances of you actually being able to take the ordinary loss are much higher versus capital loss much less. So that one, very important to understand. And finally, number 16, our last tax theme. So almost all code sections, they have a definition area within that specific code section. So the general rule when you're dealing with code sections and trying to define something is you look at the code section at issue. Okay, so if you're dealing with annuities or alimony, okay, which alimony depends on the year whether it's taxable or not, right? So you might have to look in the past. Defining alimony, you will find that in Section 71, back when Section 71 was, published, okay? So defining gross income, or defining alimony, you would actually find that in that code section. So the first place you would start is looking at the code section at issue, right? So Section 71 dealt with alimony. That's actually what it was called. So you're like, okay, well, what is alimony? You would find that defined in Section 71B, what alimony is, okay? Now, if a code section does not define a certain item, you might find it elsewhere in another code section. Remember, we learned about for purposes of this subchapter, for purposes of this part, for purposes of this subpart, right? You might find it in another code section, but there are some code sections, mainly the most important one being Section 7701, where it has a lot of definitions. So if you ever find yourself looking for a definition of a term, corporation, things, different types of taxpayers that applies throughout the entire tax code, 7701 will provide some specific general definitions. And it's really important. I recommend you go look at that. Stop the video. Go pull up Section 7701. Look at these general definitions. Very, very, very helpful. Okay, because some of these definitions are things that are not defined in the code in the various code sections, but they are used throughout the code, like the definition of corporation. And corporation makes a big difference because, as many of you know, there's a different tax rate for corporations than there are for individuals. So whether you're a corporation or you're taxed as some type of different tax entity can make a big difference, right? It might be taxed as a partnership and it flows through as individual tax. So very, very important. Now, also important to note, and I want to end the video here, right? I should always end it. I want to end it by again saying that, again, if you're watching this in the future, some of this stuff may have changed. So always keep that in mind. A lot of these tax research videos I do, again, you're not really, while I do talk about substantive tax stuff, like I give examples like municipal bond interest and alimony and things like that, in the future these rules might have changed. So don't rely on the substantive. What you're relying on in this video is the process and the specific themes, because those things will stay the same. Those things will stay true. Very, very important to understand that. And then the next thing I want to say, and the last thing that I want to end this on, is yes, the Internal Revenue Code is the most important of all the different types of tax authority, but there's going to be many times, almost all times in your tax research or tax career, tax research process, that you have to consider things outside the tax code. It's not going to be as simple as, hey, look, I found the answer in the tax code, right? If it was that easy, then the taxpayers wouldn't be paying you to do tax research. They could find it themselves. They could look it up on the internet themselves, and there's a good chance that many of them probably did try to look things up, or just look at the IRS publications or whatever they did. So yes, we always start with the tax code, but it's not the end-all be-all, okay? And perfect example is here, the last theme, right? While almost all code sections, they include the definitions of the items they provide, right? And even if you can't find it, you'll find it in our code section. There are going to be many times that you're not going to find the definition of something in the entire Internal Revenue Code, and you've got to look to things like regulations, okay, or cases, or other IRS pronouncements like revenue rulings, rev procs, private letter rulings, okay, other IRS pronouncements out there. Okay, so I want to end on that because, for example, I talked about the definition of property earlier. Property is never defined in the tax code. Okay, it's been defined through case law. Okay, through case law, and been defined broadly. Okay, so that's just an example of, like, if you're trying to determine, hey, this taxpayer has this item, is it considered property for purposes of, this specific code section? And that's a great question. Sometimes that might be something you have to deal with. Okay. It might be, something very, very esoteric. You're probably thinking, well, isn't property already defined broadly? Well, the courts have made that decision because it's not in the code itself. All right. So this really concludes the discussion dealing with the top themes. There's other themes out there in the tax world that you're going to come across as you become more seasoned tax practitioner. But these are some of the most important ones to help you, guide you at the beginning of your path as being a tax professional, as well as the tax research process. Make sure you watch the other videos I mentioned in this, like the top 100 tax code section video, the tax scavenger hunt, and my other tax research videos I've created, and even substantive. If I talked about something in this video that you want to understand more, like property, watch that. All right, I hope you've enjoyed this. And again, I love these tax themes, and they really do help you understand tax law.